Hey everyone, welcome to FinTech. So my stock portfolio is up over 25% for the month, with some positions up nearly 50% since July. And in this video, I'm going to be revealing my top 8 stocks to buy right now that I hold in my portfolio and why I invest in each position. So hit the like button if you want, and let's not waste any time and dive right into looking at my Charles Schwab portfolio. So in my portfolio, we can see that it's increased by 25% in the past month. But if we expand that out to a longer view, let's say 3 months, we can see that the change is around the same amount. And if we expand that out even farther to say the last 6 months, my portfolio is actually down 16%, which really just goes to show exactly how volatile stocks have been over the past year, especially high growth software stocks like the ones that I tend to invest in. That being said, if we expand out to an even longer time horizon, let's say 2 years, we can see that my portfolio is up over 50% over the past 2 years, despite the correction that we've already seen in many software stocks and the fact that most of these stocks are now trending higher. So let's now take a look at how much I hold in each individual stock in this portfolio and why I picked it to invest in. And stick around until the end of the video to see which trade I have made and what stock I bought in the past month. So the first stock that I have in my portfolio here is Datadog. Datadog I currently own 401 shares of at a value of $43,000, and that's off a cost basis of $35,000. So it's made around $8,000 overall. And Datadog is up around 12% for the month. Now Datadog is a data company. They want to unite a business's applications, security, and infrastructure all through a single pane of glass so that anybody working at that company can see exactly what is happening behind the scenes through their data. Now this gives Datadog 2 big advantages. One, they're dealing with selling products to other businesses, which means they're more recession proof than a company that sells directly to consumers. And number 2, because Datadog is operating in the data space, the actual market that they're going after is growing. Now Datadog is growing like crazy right now. They increased their revenue by 73% over the past year. So Datadog is not only growing faster than other companies in their niche, that actual market itself is growing at the same time, giving Datadog 2 different forces that are pushing it forward. This is why Datadog is my highest conviction position overall and my largest position that I currently hold. Number 2, we have Snowflake, which is another data company. Snowflake I currently have 160 shares of at a value of $25,000 roughly, and that's off a cost basis of $29,000. So this position is actually down a little bit since I first invested in it. And quick call out here, you'll see that Charles Schwab has all these companies rated as either a D or an F, but they've also had a lot of companies rated as an F that I held and made a lot of money on. CrowdStrike, for example, I tripled my investment in, and that entire time Charles Schwab was saying that it had a D rating. As far as I can tell, Charles Schwab is just using some kind of calculation to determine this rating based on the valuation of the stock, which obviously is going to rate high growth stocks like this that tend to be very highly valued a lot more negatively than a value-based stock. And there's no company that's more familiar with high valuations than Snowflake. Now, in order to understand what Snowflake does, we have to understand how companies use data. So a long time ago, companies kept track of their data on literal spreadsheets that they wrote by hand. Then that moved over into simple databases on a computer. Then those databases moved into the cloud and were operated running on someone else's servers. But Snowflake offers another order of magnitude improvement over previous cloud data systems, where they actually manage the data for you in the cloud. This means companies don't have to pay for expensive data engineers, and they can also get moving a lot more quickly. Plus, Snowflake is now reaching the size where they actually create data edges between companies, meaning companies in a certain industry can actually share certain data with each other. So for example, if a bunch of medical companies were all on Snowflake, they could create data edges that all those different companies contribute data to. And because that data is fundamental to how the businesses work, this makes Snowflake extremely sticky for their business customers. Now, people have always seen the value in what Snowflake was doing, even back when it was a private company, and because of that, Snowflake has always been one of the most highly valued stocks out there. In fact, if we look at Snowflake's price to sales ratio, or PS ratio, back when they first went public, they had a price to sales ratio of 148 to 150, and at their peak, I think they got as high as 180. This means Snowflake's market cap was 180 times higher than the actual revenue they were bringing in, which is unbelievably high. But that's also because Snowflake was growing ridiculously quickly. If we look at Snowflake just over the past 4 quarters, they grew 104%, then 109%, then 101%, and in their most recent quarter, they grew 84.5%, which is a slight slowdown in terms of percentages, but in terms of overall revenue growth, it's still increasing. It's just that Snowflake's base of revenue is so large now that it's hard to grow over 100%. At the same time, while Snowflake has been growing, their price to sales ratio has actually been dropping, and it's currently sitting at basically the lowest it's ever been, at 32.94. And while this is still high compared to, say, a value stock, you have to remember that Snowflake is growing at 84% per per year. So if their stock price didn't increase and they double their revenue, well then their price to sales ratio is going to be half as high next year as it is this year, and then half as high the year after that, and half as high again, meaning that over time, Snowflake becomes a better and better deal as the stock price doesn't rise. Of course, in reality, I think the stock price is going to rise to keep the price to sales ratio at least somewhat steady or even increase it, which is why I'm investing in it and why it's my second largest position overall. Number 3, we have Cloudflare, which I think is actually the company on this list that I may have owned the longest. Cloudflare I own 317 shares of at a value of $22,000, and that's off a cost basis of $20,000, so it's made around $2,000. Now in reality, I've actually sold some of my Cloudflare shares that I bought earlier on, so I actually have made quite a bit more money in this stock than is currently showing in Charles Schwab. Now Cloudflare is a company that wants to make the internet itself work better. They started off just running a CDN service, basically hosting websites for other companies, but then they decided to offer products that could protect these companies via a firewall. Then they thought, okay, if we're already analyzing all this traffic going into the website, why don't we not only block the traffic for bad users, but optimize the traffic for good users? So they got into performance, and then they got into networking products, then they got into offering cloud services. And at this point, Cloudflare is actually managing to compete with some of the big cloud service providers like Amazon, Google, and Microsoft, which would have been unheard of 5 years ago. Cloudflare may be the most innovative company that I have in this whole portfolio, and they have a whole part of their website called What's New at Cloudflare, where they talk about all the new products that they're constantly launching. Just in June of 2022, I counted 8 separate new products that Cloudflare was launching for their customers, which is absolutely insane. And last but not least for Cloudflare, their stock price is currently up 36% for the past month. So this stock has been doing extremely well recently after they reported their most recent quarter of earnings, where they show that they've continued to grow at 50% year over year, which isn't anything new for Cloudflare considering they've grown at 50% for basically every year for the last half of a decade. So now we're going to move on from my top 3 largest positions and into my more mid-sized positions, but leave a comment on what your top 3 stocks are right now. I'll try to go around and respond to everybody who leaves their stocks in the comments. So number 4, we have ZScaler, which I currently own 112 shares of at a value of $19,000, and that's off a cost basis of $27,000. So this stock has actually lost around $8,000 overall. And part of the reason for that drop is because I've invested more money in ZScaler recently during the drop that we've seen over the past year. Now ZScaler is a security company. They offer something called zero trust security. So in a traditional computer network, you set up a firewall to keep all the bad guys out. The problem is if a bad guy can get into your firewall, suddenly he has access to everything in your network. ZScaler solves this by almost putting a firewall around every single individual computer, application, and person on the network. So even if you're inside the actual network, you have to authenticate every time you talk to someone else. And they do all this in a cloud native way, which makes it really easy for companies that are moving into the cloud to move over onto Zscaler. And we can tell that Zscaler is grabbing a lot of new customers, because if we look at their earnings growth over the past couple years, a year ago, they grew their revenue 56% year over year. Then that increased to 61% year over year the next quarter. That increased to 62% year over year the next quarter. And in their most recent quarter, they again grew over 62% year over year. Security is becoming an ever bigger and bigger issue for companies as we see more and more really high profile security breaches. And so companies like Zscaler are going to benefit from that publicity and from people just moving over into the cloud. So I see no reason that Zscaler will not continue to grow at its current rate for the foreseeable future. Next up, we have ZoomInfo, which I own 194 shares of at a value of just under $10,000, and that's off a cost basis of just under $12,000. So this stock is also slightly negative overall. ZoomInfo owns a giant database with all the information of pretty much every business person out there, and they use this information to make connections between sales and marketing folks. So they can make it so that salespeople can actually reach the people in companies that they're trying to sell to, and the people in the companies are only reached out to by people offering a product that they would actually want. So it's a win-win. ZoomInfo has larger ambitions to become the go-to company that you use to grow your business, and they plan to completely take over the B2B data and software space over time. And it's starting to work out. They have customers like Google, Zoom, Snowflake, and T-Mobile, along with 30,000 other businesses signed up to their platform. And similar to other companies in this portfolio, they're also growing extremely quickly, increasing their revenue 53% year over year. Just like all these other stocks, ZoomInfo is going to benefit from companies outsourcing more and more of their digital needs, because it's just more efficient to have one company handle one specific need for you so that you as a business can focus on your core competency. This isn't a trend that's going to change anytime soon, and it's a trend that's being driven along even faster by things like AI, or companies moving to the cloud, or the proliferation proliferation of just massive amounts of data. And that's kind of an underlying trend and theme between all the different companies that I'm currently investing in. Number 6 on my list, we have Sentinel One, which I own 274 shares of at a value of $7,500, and that's off a cost basis of nearly $13,000. So this stock is actually down pretty substantially. Now, what Sentinel One does is they're a security company, but unlike ZScaler, they don't focus on zero trust. They're more like a super advanced antivirus. With a traditional antivirus, they get smarter over time by people identifying attackers, adding them to a database, and then the antivirus is able to recognize those attackers again in the future. What Sentinel One is doing is using AI to make this whole process automated. This means you don't need people manually entering viruses into a database or even to have seen viruses in the past to protect against them. Sentinel One's platform is smart enough to recognize patterns in code that would identify a virus and then combat them before anybody else has even seen them before, which over time will remove more and more zero-day exploits, or exploits that nobody has seen before. Sentinel One is also growing faster than any of the other companies in my portfolio, growing 109% in terms of their revenue year over year. Now, I think one of the reasons Sentinel One has been struggling more than these other stocks recently is because they do have competition in this space, and their competition is a company called CrowdStrike. CrowdStrike offers essentially the same product as Sentinel One, an AI-driven antivirus along with some other products as well. The difference is CrowdStrike is way bigger than Sentinel One. Now, as we move into a potential recession, one of the kind of rules of thumb is that there's consolidation in the market. So whoever's the biggest in the market tends to take more market share during a recession, which may be what the market is worried about with Sentinel One. Now, personally, I don't think that the security market is going to be run by just one company. There'll probably be 3 or 4 by the time everything settles out. So I'm okay with keeping some money in Sentinel One, but it's not going to be one of my top 3 largest positions anytime soon. After Sentinel One, we move into the 2 fintech stocks in my portfolio. First up, we have Upstart, which makes up stock number 7 on my list. Upstart I have 124 shares of at a value of $3,800, and that is off a cost basis of $28,000. So this stock is down $24,000 and something like 90% overall. And this single stock is responsible for the majority of losses that I've seen in my portfolio. Now, what Upstart does is use AI to evaluate risk for loans. So a traditional credit score model just looks at one number, your credit score, to decide whether or not they should give you a loan. But Upstart gets rid of the credit score model and instead uses thousands of different parameters that they can feed into an AI model, which then can predict much more accurately whether or not you're going to default on a loan. This allows them to offer loans to people who wouldn't qualify for a traditional loan, or offer better rates to people who would qualify but are actually even safer than people realize. Best of all, Upstart outsources all these loans to other banks and actually sells to them as their primary customer, which means Upstart is not very exposed to credit risk from holding loans on their books. Now, based on the fact that Upstart's stock price is down 90% over the past year, you would think that something went wrong with their AI model, or their model just didn't work, but that's not true at all. Upstart has shown time and time again that their models actually substantially outperform the market average, and yet the stock price is not reflecting that. I think that has a lot more to do with just macroeconomic problems in the loan market in general, plus other companies being slightly more conservative with trying out something like Upstart when we're in a potential recession. So the technology is there and it works, it's just the business isn't in the right place right now to be growing extremely quickly. But that could change very quickly in the future if the recession does end. Upstart is also starting to branch out of the personal loans business, which they estimate at $129 billion a year business, and into the auto business, which they estimate at a much larger $770 billion. And then from there, they're also going to expand into the mortgage business, which is worth $4.2 trillion. Upstart is definitely not a short-term play, and they may not really increase their stock price dramatically in the short term, but over a much longer time horizon, maybe 5 to 10 years, I think Upstart does have the potential to completely disrupt the industry. But we're gonna have to wait and see, which is why I've kind of left Upstart as one of my smaller positions for now. Then finally, we get to stock number 8, which is SoFi, which I own 321 shares of at a value of $2,000, and that's off an initial investment of $4,000, so it's down around 50% overall. SoFi's goal is to replace the 500 or so legacy banks that own 99% of the banking market share, and basically starting with millennials and Gen Z, grow as that population ages and makes more and more money over time. SoFi has 3 main businesses: lending, technology platform, and financial services. They use their financial services, which are things like the SoFi app or the SoFi credit card, like a top of sales funnel that then funnels customers into the more high value areas of the company, like lending. This unique business model also allows SoFi to make way more money per customer that they actually get onto the platform, meaning that they can spend more money on things things like marketing, like they did with buying the SoFi Stadium, because they know they're going to make it back up on the back end. This also makes SoFi kind of comparable to a company like Apple, who uses their ecosystem of products to keep customers interested. SoFi has a whole ecosystem of products that they offer to customers, which are actually more valuable when used together than used independently. Just as an example, a SoFi customer who used the SoFi app first and then moved over into lending is twice as valuable to SoFi as a customer who just went straight into lending, showing that there's more value created when a customer uses multiple of SoFi's products. Now, SoFi's stock price declined a lot because they were hit pretty hard by the moratorium on federal student loans, which was the original bread and butter of SoFi's business. But SoFi has now managed to pivot over from student loans into personal loans, and they're actually making more money now with personal loans than they ever did with student loans, and yet the stock price is around 50% lower than it was when they first went public. This puts SoFi in a really good position, as the potential moratorium on student loans could be ending soon. So if the moratorium on student loan payments ends soon, SoFi's student loan business will basically 4x overnight, bringing their total revenue to substantially higher than they've ever seen in their history, while the stock price is sitting below the all-time high. Now, SoFi is still the smallest position in my portfolio overall, but I did buy an additional 150 shares in this company a few weeks ago, which I posted on my Patreon along with all the other stock trades that I make in near real time as I'm actually making the trades, along with full reviews of my stock portfolio. Now, I'm not presenting anything in those stock portfolio reviews that you can't get for free by just watching these videos. The Patreon's just there if you want to get them a little bit earlier, and if you want to get them twice a month instead of just in the middle of each month. Don't forget to grab your free stock from Public, which could be worth all the way up to $70. Don't forget to like and subscribe, and I'll see you next time.